Good day all, welcome to another Black Bull Markets video. In this video, we're going to be discussing how to become a successful swing trader. Now, firstly, what is swing trading? Swing trading is a technique that traders use when they like to profit from longer term moves in the market. Now, that could be based on fundamental decisions such as interest rate paths or outlook over certain economies. For example, the outlook of growth of the US, the outlook of growth for Japan, and they would like to base their decisions on longer term views on these certain current countries and their respective currencies, of course. Secondly, technical levels. If you're looking at a currency that is at multi-year lows and you're looking to continue to sell that, or look to perhaps trade against the trend and look for a longer term move back up to the upside, you would be looking for these long-term moves or a trade with a longer-term perspective for profitability. Now, first thing you do is identify which asset is going to pay you overnight on the swaps for holding that particular trade and in what direction. So we've identified one here, which is probably one of the most highest yielding assets for overnight holding, and that is the dollar against the Swiss franc. So, for example, if you go into your platform, you right-click, hit specification, we'll just do that again, and you scroll down to your swap long, swap short, you can see it's 4.3 for holding a long against 10.89 negative for holding a short. Now, how do you identify this? Well, there's a great website called tradingeconomics.com, which shows you the interest rate differential between two different countries' central banks. So let's first type in the Switzerland interest rate, and we'll be able to see that Swiss, as well as a lot of the Eurozone, have been holding negative interest rates for a while now. The latest print being minus 0.75. Now, if you compare that to the United States interest rate, which gives you a positive yield, you'll be able to see that that creates the positive differential for holding a long dollar against a short Swiss franc trade. So let's just get this interest rate up here, and you can see that depicted on the chart. So it makes sense. If you've got you're buying a currency that's paying you to hold it overnight, that's the dollar. Strongest currency in the world, you're getting paid to hold it overnight. You're going to get positive interest rates if you're buying dollar against a negative yielding pair, for example, the yen. So the yen, the interest rate minus 0.75, apologies, not the yen, the Swiss franc, similar to the yen as well, which is very low. We'll discuss that later, but that's your first step. You want to be a successful swing trader, you've got to trade knowing your swaps, knowing your fundamentals, and understanding interest rates of these countries. So if you get news that the interest rate of a certain currency is being cut, then you know that's going to affect your underlying swap rate. So let's have a look on a monthly chart firstly. So the dollar against the Swiss franc generally zeroes in about the 1 mark, but you could get opportunities for pullbacks. For example, we've identified this little wedge here, pull back into these zones for buy up again. So these are certain strategies you could think of. Remember, these are monthly candles, so this is a very, very long period of time that the markets trade within, and you know, perhaps traders like to use a fib, for example, to identify potential pullback areas. If you drop below this 38.2 or this 50% ratio, then you could potentially have areas of interest for buyers looking to come in, hold that position back up to this equilibrium 1 mark if you're looking at that, and getting a positive yield on holding the long position. So that's really what you want to be looking at. So I mean, for example, if you held a trade from around the 97-cent mark all the way to the 1 mark, just shy of it, it's about 300 pips, and say it took a month to get filled, that's 20 trading days. So 20 times 4 is 80, and you're making 80 Swiss franc on the deal, as well as 300 pips on your trade. So this brings me on to the second point, and that is to trade small. Because you're trading with a view of a long-term position, you really want to not be trying to use a stop loss, but instead of a stop loss is to trade small. So that could be a micro lot or a mini lot, looking for these longer term trades, perhaps as a hedge for your other for your main portfolio, or any other shorter term trades that you have in line. So that's one asset. Another asset that people love to trade that yields positive swap is the dollar yen. Now we know that the yen again pays you pays you a very low rate actually. So you get paid for holding a long 318. Again, we can identify this with our trading economics tool. So if we have a look at Japan interest rate, and if we compare that to the United States, there you go. And you can see again a differential between the two. So minus 0.1% was the most recent print, and you can also go back in time to see how it's been acting. So you can see there was a time where it was pretty much on par, but now you're seeing these changes being reflected in your platform here. So again, that means if you go back on a monthly chart, you're looking potentially, you've identified this level, you're looking for positions in which you can come back in and buy the market, and you can identify longer term support areas, perhaps areas of interest that you may feel that the market could come back into and come back up, to hold that up until a target of your preference. So that's really a very straightforward methodology on how to identify assets in the FX market for you to be a profitable, or look to be implement a profitable swing trading strategy within your own trading strategy, either as a hedge for your shorter term positions, or if you just generally don't like to look at your charts all day, you'll have a price target in mind, you'll know what your worst case scenario is, you're trading small, looking at positive yielding assets such as the dollar against other pairs which are charging you for holding that overnight, staying in touch with the underlying fundamentals, and also keeping an eye on key technical levels that you could be of particular interest for buying or selling a particular pair, depending on which is going to pay you more. So do keep these in mind when you hold positions overnight, whether it's one night, 5 nights, a year, 2 years, whatever it may be. You've got to know what your swaps are, what you're paying, and how they're determined from the interest rate differentials, and really keeping this all in mind alongside your risk management. So I do hope this video has helped. Do subscribe, like for more videos, comment below for any questions. We're happy to help. It's a very brief analysis on how you can become a profitable swing trader. All the best.